If you have any doubt, please let me know. Before to enter in the topic of task that we were discussing in the previous class, it's important to know before finishing the part of investment analysis, I'm going to give you two important concepts that are very related to investment analysis. One is a market analysis and other is market efficiency. So in the case of market analysis is a quantitative and qualitative assessment of a market. As we see in investment analysis, analysis basically is a method in which we observe the behavior of a certain area or of the behavior of a certain sector in the economy or something. When we observe very close the behavior of something. So market analysis precisely is observe all the factors that are involved in the market. Like, for example, market size or market segments, or for example, the competition, or what is happening in the economy to determine what will be the reaction of the market and be able to predict the future. No, and if the manager that is analyzing a portfolio investment is not on, he needs to analyze not only the behavior of the security or the financial. This guy needs to analyze the market, the behavior of the market. So basically, this is a market analysis. And some authors, some investors, some investigators has said that market analysis involves cultural and legal regulation. So market analysis is more analyzing the things that we have around in the world, and investment analysis is based on analyzing a certain security or a certain combination of securities. So market analysis is a very important concept to be understood in this class, because at the end, if we want to understand how is the behavior of a security, we need to analyze the market, no, and consider these other factors that are not related maybe in particular with the security, but that indirectly are affecting the security. So this is a very important concept. Another important concept is market efficiency. Says that a market is efficient because the price of the security consider all the factors, all the external factors. For example, the external factors that we saw in market analysis. So market efficiency says, okay, if you analyze a security, the security has all the external factors. This is market efficiency. Obviously, market efficiency needed to be proved, because some authors, some scholars says that obviously this is not possible, no, that all the securities and all the financial instruments have the external factor factors reflected in the price of the security. No, so some investigators are in favor of this position of market efficiency, and other investigators of other scholars say that no, this is not possible. So market efficiency has been very, very, very debatable topic. In fact, market efficiency, the concept of market efficiency, was the base to create an hypothesis or a theory very, very famous in this field, that is efficient market hypothesis, created by Eugene Fama in 1970. So maybe if you look for this topic, market efficiency, on the literature or on internet, this concept is very related to efficient market hypothesis, and this is, well, I feel that this is the most famous theory related to the market efficiency concept. These two concepts, market efficient market analysis, we can understand what is a theory. No, a theory, I mean a theory that implies this concept to analyze the behavior of the securities and the market. So investment theory is a process in which we analyze the different factors associated with the process of investing. Then this part maybe will be the investment analysis. So investment theory includes investment analysis that is understand different factors associated with the process of investment, and additionally, investment theory is very concerned about the factor that could affect the security. Why? Because we want to take the best decision to make an investment. Theory implies a process in which we need to consider different factors associated with the investment process, and additionally, we need to look very closely the behavior of the portfolio and the market to take the right decision. And the third part of a theory is because we want to reach a goal or a purpose. So basically, this is investment theory. Keep in mind that investment theory implies investment analysis and implies a market analysis. Not precisely market efficiency, but at least investment analysis and market analysis. The principles of all the theories that you can find on the internet or on the literature, we will consider these 4 principles. The first principle is identify the investment portfolio. As we have discussed in previous classes, we need to identify the profile of the client or our profile to know which kind of securities we are going to choose to invest. Second step, investment theory all the investment theories consider diversification. It means not only invest in one type of securities or in one type of investment, is divide our money, our funds in different options, in different cages, because if some security decrease, or if one investment is not going on the way that we want, we don't have all our money on the security, because we have different investments. So if we will lose only one part of our money and not all our money. Because imagine if we invest all our money in only one option, if this option didn't result as we expect, so it means that we will lose all of investment. So other thing that investment theories consider is diversification. And the third thing that investment theory consider is degree of risk and potential return. What will be the level of risk that the investor could or want to take? Remember, if you take a very huge risk, your returns or your yields will be huge too, because the risk is associated with the returns. And if you don't take a lot of risk, your return, you will have a return, but maybe these returns will be not very huge, because remember these two concepts, risk and returns, or yields or profits, are two concepts that are very close. So this is another important thing that investment theorists consider. No, what is the level of risk that the investor wants to take? Because according to this, this will be the factor that will move the returns that an investor could obtain. And other is all the investment theories consider the amount of information and to take a correct decision. I don't know if you have heard when, for example, in stock exchange markets, the managers or the people that are working in these places scream, no, buy shares or sell shares, is because they are analyzing the external factor, the environment, the amount of information available to recognize what is the correct price to sell a stock or to buy a stock. Maybe if the manager detects that the stock that the investor has is increasing, so it means that the investor could sell this stock, because in this moment the investor could earn a lot of money, because his stock or his security is increasing, the price of the security is increasing. On the other hand, if we see with the information available that or shares or stocks or the stock of the investor is decreasing, I mean the value of the security is decreasing, so in this moment we need to sell this security or this stock, no? So buying or selling depend on the amount of information available and if we got this information in the correct moment. I wrote here two examples of investment theories. Plenty of investment theories, but these are very easy to understand, and I feel they are very controversial too. One of these is the vision market hypothesis that we reviewed this theory says that the market price of shares has information about the future, the past event, and consider all the external factor in the price of the shares. So this is efficient market hypothesis. So this is very famous. And the other hypothesis that I wanted to tell you is 50% principle, because this theory is very controversial, because I feel that it's very easy, you know, is very easy, and probably is a rule that is fixed, and maybe this theory it's true, but it's very controversial, has been discussed a lot. That is 50% principle. Basically, this theory says that is we have a stock, no, or a portfolio, and we detect that the portfolio is increasing. So in a certain point, if you imagine a graphic, and the behavior of the security is increasing, when the security reaches its highest point, then the security decrease 50% of all the gains that the security had. So it means, in an example, that if we have a security and we observe a trend or that has increased 20%, in the future, this when we reach the 20% of profits, this will decrease 50%. So in the future, after this 20% that we won, then we will win only 10%, 50% of the 20%. So the curve, the behavior of the security will be very, very wavy. So maybe with peaks and then decrease 50%, and then another peak, and then decrease another 50%. So this is basically the theory. I feel that this theory observe the of the market, of the stocks, of the securities, to establish a theory, no? So even when this theory is very basic and maybe very easy to understand, this theory implies that someone observed the behavior of the security to say this situation happens a lot. So this could be a theory, no? A theory that analyzes the behavior in the market and analyze the behavior in particular portfolio or in particular securities. So these are two investment theories, but as I've told you, there are a lot of theories. The most common that you can find in the literature is flow and funds theory, trend walk theory, capital asset pricing theory. Other very, very important, capital asset pricing, or you can find modern portfolio theory. So if you want, you can check this theory. We are not going to discuss in depth because there are a lot of theories, but keep in mind that these theories are fundamental to understand portfolio management and analysis investment. So yes, these are very important. So till here, we have this chapter. We finished this chapter, and then we are going to follow the class to discuss taxes. So till here, do you have any question? or any comment? Okay, let's continue. So taxes, for most of the people, taxes implies a headache, because some people hate them, some people not so much. But two things that are very sure in our lives: death and tax. So it's important to know more about taxes. So in this chapter, in this four topic, topic, we are going to know what are the taxes, type of taxes, characteristic of indirect and direct taxes, and implication for relevant stakeholders. So topic, but we are going to concentrate only in these topics. What are taxes? Taxes are mandatory contributions that are paid by individuals or corporation. I mean, taxes are paid by person or by a corporation, you know? And these taxes are paid to the government. Government could be local, regional, or national, because we have different taxes. Some taxes go to local government, other maybe not local, regional, depending on the country, depending on the regulation, the tax regulation in each country. But basically, we have different places in which our taxes go. So tax, basically the purpose of taxes are paid government activities to improve the style of life in population, in people. So because the government uses these funds to do a lot of things, no? Public transport, electricity, what other thing? Schools, maybe cultural centers, museums, parks, maintain the quality of life in the country or in a certain area. So our taxes go directly to the government. Needs this money to do a lot of things for a population. From an accounting perspective, there are various taxes. For example, payroll taxes, federal and state income taxes, and sales taxes. And as I said, tax system vary depending on the nation and depending on the country. And for that reason, it's important to know the law before to calculate a tax, because maybe in all the countries we have the same tax. That would imagine that the same tax in all the countries would be the income tax, because all the people that we profit, or basically that we earn money, we need to give a part of this money to the government to do this activity, to do those activities that I have mentioned. So I feel that this is a very common tax that all countries could have, income tax, but we have probably another taxes that could vary depending on the country, depending on the environment, the economy, cultural factors, for example, the activity, that, for example, in my country, in Mexico, a lot of activities related to tourism, but maybe in other country, this activity could vary. So depending on the main economic activity, the countries has their own taxes. So it's important to know the regulation of the country, to know what kind of task the country has. I'm going to talk about a little of the history of taxes. Taxes are very, very old. The first signals of tax was 100 years ago in Mesopotamia. And in this area, normally people pay taxes in form of cows. So with a cow or with a bull or with an animal is fun nowadays, but this was the way in which the taxes was paid on the past, were paid on the past. Another sign that we have, another maybe fact that we know about taxes in the past was in Egypt, that they pay 10% of tax on property when someone passed away. So this is another fact that we know now that about in the past. So since then, we can say a lot of things about it in the past, depending on the country again. And for example, in China, in 2006 was eliminated one of the oldest taxes that was paid in the agricultural sector, and this tax was created 2,600 years ago. So imagine, this was a very, very old tax that was paid in China. So if this task was eliminated in 2006, I feel that is the nation is because the government wanted for more this field, the agricultural field, and to help and support farmers in China. And these are very, very uncommon or maybe very weird taxes along the history. So for example, in Egypt, in the past, Egyptians needed to pay a tax related to oil. That this tax was known that fact tax, and this is very crazy nowadays. So imagine, we have a lot of problems with junk food, and we are not paying a lot of tax in junk food. So, but in the past in Egypt, all was taxed. Another funny fact is that in Roman government, a slave used to pay taxes for his or her freedom. So this is another funny, not funny, but this is another unusual that maybe if we think this fact nowadays, it would be very, very impossible or very crazy. In Middle Age, European governments pay tax on soap. In Russia, the Emperor Peter the Great said that people with birds needed to pay taxes. In Canada, another tax was another funny tax was in Canada that they created a tax for Chinese people because Canada detected a lot of Chinese immigrants. So in 1885, Canada created this tax, to Chinese immigrants. And maybe this is a tax that nowadays will be not fair because of discrimination. I feel so, but yes, Canada had this tax. And another tax is Japan that imposed a tax on, for example, and always and in for that reason, Japan started to mix whiskey with water in order to avoid this tax, because this tax on whiskey depend on the percentage of alcohol by volume. So I would like to know about your countries. What is an unusual tax in your country? Could you share with me, for example, Lino? Could you tell me what is your country, and what would you say that is an not probably not uncommon, but at least a tax that you would like to discuss here in class?
I'm from Brazil, so there we have a lot of tax,
Mm-hmm.
and some of the tax I think is not fair. Like we pay one tax, the name is FGTS, FGTS, uh, and this is like one security for when you are working, and when
Mm-hmm.
you leave the work, the government give you some money for 3 or 6 months.
Mm-hmm.
But for the government to help you give this money, you need to work almost 1 year. So if you work 11 months, you
Mm-hmm.
don't have a right for receive that, and the government stay with your money, don't give anything back to you.
Okay, so if you work more than 1 year, you
You
get
can
your
receive it 3 months of you 3 months of salary
ah
when you get fired.
okay. Yes, this is uncommon because in Mexico at least we don't have this, but
Yeah, it's really stupid.
okay, thank you, Leno.
Thank you too.
Um, okay, perfect. So let's move on to the taxes. So this is an overview of taxes. Maybe these taxes could vary, but these are basic taxes. Maybe probably in most of the countries. There are several common types of taxes. One of these is income tax. That income tax is a percentage that we need to pay only for the fact that we earn money in form of salary, in form of profit, as I told you. But if a person or a company earn money, we need to pay a tax. So income tax is general for everyone, for persons, for people, or for companies. Another is payroll tax. That this is percentage that the employee needs to pay to the employer to pay social security programs and medical care So this is a payroll tax that probably includes when we receive our salary, we receive our salary without this payroll tax and income tax. So these two taxes are combined in the case of salaries, but basically the difference is that income tax is only for the income. Payroll tax, this money goes to pay Medicare and Social Security programs, and the percentage obviously vary according to the region. Another is corporate tax, that this corporate tax is only for corporations, for firms, for companies. So corporate tax is a percentage of corporate profits taken as a tax by the government to fund federal programs, as we saw. And then sales tax, that the sales tax is more related, is more associated with certain goods and services. For example, let's think in tobacco, for example, that tobacco needs to pay a tax, and for that reason the price of tobacco, depending on the country, is more than the other. I can say that, for example, here in London, or in general in the UK, I was very surprised because cigarettes are very expensive. But if I compare, for example, a package of cigarettes here and a package of cigarettes in Mexico, in my country, the difference is huge. But why I can see this difference? Because of the taxes. So imagine here, the box of cigarettes maybe are in 10, 12 pounds, and in Mexico, like in 3 or 4 pounds. So imagine the huge difference between these two products. And this is because sales tax. And we can bring a lot of examples, maybe in alcohol, maybe, I don't know, in certain products, maybe in meat. So maybe, or maybe in devices, for example, the cost of an iPhone in the USA or in other country, because these kind of products need to pay taxes, and this is sales tax. Property tax, that is based on the value of land and property assets, that, for example, in some countries, the owners of a land pay taxes every year or every certain period, only for the fact that they have a land or a property. Tariffs, taxes on imported goods imposed with the aim of strengthening internet business. That is maybe the example that I said related to tobacco or alcohol or a lot of products. And estate tax, that is a task that a person that died needs to pay, if they have properties, and they need to pay tax when this person, not this person, when the family of this person, when the person that task. Fact about taxes. So this slide contains a lot of important information in 2021, sorry. This information was created by the OCDE. So because OCDE is an institution that evaluates all the economic trends in the whole globe, in the world. So in this page, this organization has a very interesting information, like this in this slide. Is 23.54%. So basically, in 180 jurisdiction, the average of the tax rate is 23.54. So Asia, other fact, another very interesting fact that I found in this page is that Asia has the lowest regional average rate with 19.62%, and Africa, opposite, Asia has the lowest, and on the other hand, Africa has the highest tax rate with 27.97%. So maybe we can find some countries that has, for example, more than 27.97%. Yes, of course, but this information, this data is based on the whole country, the whole continent, and yes, all Asia, the percentage, the average percentage is 19, and in Africa, 27. In 2021, 20 countries made changes in the taxes. For example, in Bangladesh, Argentina, and Gibraltar, they increase the corporate taxes, and in the rest of the 20 countries, I mean in 17 countries, that include Chile, for example, or France, they reduced corporate taxes. So it is a good measure to increase or decrease taxes. We would need to discuss what is the economic of this country. Maybe the government in taxes, maybe the government is expecting to reach a specific goal, or we will need to study more about these economies to know if the increase of the taxes was a right or a wrong decision. Same in the countries that decrease their taxes. And this table, for example, this table is only to illustrate what is the rate of taxes in every and in some important that we can have the most important countries, the most powerful countries, the countries that basically move all the economy in the world. So look, for example, here in South America, we have 26.63% as an average of tax rate. And for example, if we can see, South America and the G7 are very aligned, are very similar, but you see here in Europe, the tax is smaller than in, for example, in the in America. And in the world, the average tax is 23.54. This consider 180 countries. And this is another graphic, another that maybe is more we want to see whole globe. This is a very useful picture because we can see the parts in blue are the countries that have smaller taxes. For example, this orange or orange pink is when the rate of task is increasing. Look, Brazil is very red. So yes, this is a picture of the world according to the rate of task. Okay, guys, and we have two groups of tasks. One is direct, another indirect. Direct task is basically the task that we pay directly to the government. We don't have an intermediary. So this task is associated with the amount of money that we have, no? Is easy to work and understand because only we have, for example, a rate of task that, for example, this 23%, and we multiply this by the amount of money. And in some countries, for example, the money that we earn, we need to pay a certain rate. And for example, the people that earn a lot of money, these people are the people that pay the maximum rate, no? So it's easy to understand this that direct task, but it's important to know that it's called direct because the money goes directly to the government. We don't have any intermediary between the people that pay the tax and the government. We pay directly. And other thing is in this tax, the tax is related to the amount of money. On the other hand, we have indirect taxes that these are transferred with we need an intermediary. Why we need an intermediary? Because indirect tasks are based on the products, based on the things. So depending on the things, the things have a certain rate or a certain amount of taxes. So for that reason, we need a intermediary, because at the end, the final or the consumer is the people that pay this tax. So a very good example of this is the VAT. Let's see in the next slide. So in this, keep in mind that in indirect taxes, the tax is not transferred directly to the government. We need an intermediary, and this tax is based on the product. For example, direct income tax, for example, in salary. Workers who earn an amount above a minimum salary, these people pay taxes, according to the amount of money that they earn. According to this money, they need to pay a certain rate of tax. And remember, If you earn a lot or the maximum money, you need to pay the maximum tax rate. And sometimes this income tax in salary, because when we receive our salary, we receive the taxes. So at the end, we are paying the tax, but because our employer retain this tax and the employer pay to the government, but it doesn't mean that this taxes is an indirect, because if we want, we could pay the tax directly to the government. Sorry, but normally this is a common practice, but we can pay the income tax of our salary directly, and maybe in some jurisdiction we need to present a declaration of we need to say to the government how much we have earned during the year, and how much the company in which we work has paid. And according to this, at the end, we present our taxes. If we paid in excess, we receive this excess, and if we pay during the year less than the less taxes that we needed to pay, we need to pay of the countries. This is the process. No, every month we pay a certain amount of taxes, but then at the end we take all these payments and we calculate a general paid every year. So this is a process. And one the example of an indirect tax is the value added tax, or VAT, that is a percentage that is added to a non-essential goods. And at the end, if we buy, for example, a can of soda, this includes the VAT. But if the shop that sell this soda, when the shop that sells this soda buys this soda, obviously this shop pay the tax for this soda. But when the shop in which we buy this soda sell to us, we pay the tax that is included in the price of this soda. So at the end, the consumer is the person that pays the tax. No, maybe the owner of the shop pay the tax, but at the end the owner will sell the soda to the consumer, that will be the final person that would pay the tax of the soda. So this is an example of indirect tax. We have two implications. Okay, 1 minute, and then I'm going to finish this slide, or maybe we finish this topic and then because I noticed that now it's 11. But let me finish this topic, and then we can go to the break. And when we have two implications, we have many implications of taxes for stakeholders. One implication is that when companies have created profits, companies have two ways. One is take the money that earned during the year and reinvest the money. Another is take this money and divide it in dividends to give the shareholders their money. So basically, the companies have two options: reinvest this profit or pay dividends. But what happens with taxes? For example, if the money that the company earned is reinvested, it means that the company, before reinvesting, the company paid taxes, paid a corporate tax. So basically, the reinvestment is without taxes because the company has already paid taxes. But in the case if the company decided to give dividends, so first the company would pay taxes, the corporate taxes, and then when the company gives the dividend to the shareholder, the shareholders will pay another tax because the owner of the stock or the shareholder is receiving income. So as we saw, if we receive income, or if we receive money, or if we earn money, we need to pay taxes. So this is of dividends. The company and the shareholder will be paying twice. First, corporate tax, because corporate tax, and then when the dividend is paid to the to the shareholder, the shareholder will be paying income tax. So this is a problem. And this is a problem in case this is an implication of taxes for shareholders. So for that reason, many companies avoid paying dividends to shareholders. They prefer reinvest the money. And if we remember previous classes, equity securities and debt securities, for example, a corporate tax law of expenses. So it means that even when the corporation need to pay tax, they receive a lot of benefits, like, for example, deduction of interest, depreciation, and interest. So keep these these benefits that corporation have according related to taxes, but not dividends. This means that if the shareholder receive a dividend, they don't have the option to decrease, for example, depreciation or interest. So this is a benefit for corporate tax, but not for dividends. Therefore, there is a tax. For example, if we think in a company, if we want to invest, it's better invest in debt, because in debt we are receiving or paying, depending on which exercise you can see, we are managing interest. So if debt managing interest, and we have a benefit in the case of interest here in corporate tax, is better invest in debt, or is better if the company emits debt, issued debt, rather than equity, because equity is related to dividends, because in equity it implies stocks or shares. So shares or a stock is related to dividends. So this is a way in which we can associate securities with taxes. Remember, in debt we are working with interest, and interest is a benefit. Is a benefit when we pay taxes. And equity maybe is more profitable, is associated with dividends, and in dividends we will paying twice. And this is an example. For example, we have here earnings before interest and taxes. The firm A won 100 and the firm B won the same. So in this case, imagine that the company has the company emitted debt, securities, but in debt. So it means that the firm A has interest. The firm A paid interest. And so this amount, the income minus the interest that the company A paid for emitting debt, we have a tax net income of 6. Multiply this tax net income by the percentage of tax rate, let's say 35%. Income of 39% a net cash flow or 79. That this 79 is made by the net income 39 plus interest, because we receive here a benefit. But this doesn't happen with firm B, because firm B earn only 100. They don't emit any debt. For that reason, firm B doesn't have any interest to manage. And we have here in firm B a taxable income of 100. If we multiply this 100 by the percentage of tax, we will have a net income of 63. So probably the net income in firm B is, but if we analyze cash flow, firm A will have a better cash flow. Maybe not a net income, but a better cash flow. And okay, now let's go to the break. I'll see you here in 10 minutes. We are 11:07, so I will see you here 11:17. The topic of taxes. So now we are going to enter topic 5, laws and regulation controlling the financial services industry. First, we are going to review how laws and regulation can control this financial services industry, how we can evaluate risk, and what are the mitigation method used in investment. And at the end, we are going to check a practical risk mitigation methods. Laws and regulation controlling the financial service industry. Financial regulation is a synonym of supervision. That this supervision needs to be applied in financial institutions, because then this financial institution needs to comply with certain requirements, restrictions, and guidelines in order to maintain a certain stability and integrity in financial system. This supervision or this financial regulation could be held for government or non-government organization. These depend on the structure in the country. Some countries decide to support or to delegate this activity in a government institution, other in a non-government organization. And this financial regulation has also influenced the structure of banking sector by increasing the variety of products. So depending on how is the structure in the banking sector in a certain area, for instance, certain country, this structure will determine the financial regulation that applies in this location. We have three objectives in a regulation. One is financial stability. The regulation look for maintained stability in financial system. Consumer protection, because remember that we deposit our money in different institutions, in different financial institutions. So at the end, the government is very worried about protect the interest, or in this case, the money of the investor. So maybe we invest in some products that a bank offers, or maybe we have our savings in a bank, and we need to be very sure that the financial institution that has our money is operating accordingly with the law. And the third objective is market confidence. That is important to believe in the market. No, is important to control not only financial institution. Is also important control the market. And when I'm talking about market, I'm talking about a stock exchange that we see this topic. We saw this topic in the previous lessons. And additionally, of these three objectives, we have three types of regulation according to the that objectives of financial regulation or financial regulators. Systemic, that this is the type of regulation that is concerned with the safety and soundness of financial system. It means that if we have a very important institution, let's say a bank, a very important bank in a country in which all people invest or save their money in this bank, and this bank is not operating according to the best practices. So if this entity, let's say this bank gets a bankruptcy, not only the bank will be failed, all the financial system, because maybe a lot of people have a savings account in this bank. So this failure will affect to population. So this is a systemic risk, and the regulation, banking regulation or financial regulation, is looking for have a very controlled systemic risk. Also, we have other regulation that is called Prudential. Prudential regulation is based on protect the consumer, is protect the investor or the savers, and how this regulation could protect these interests, because prudential regulation is constantly reviewing if the financial institutions are complying with the regulation. And the other type of regulation is conduct of business regulation, that focus on more how the financial institutions are doing things, but more related with the business of the entity, no? So if you see financial stability, one objective, the objective financial stability is related to systemic regulation. Consumer protection is related to financial prudential regulation, and market confidence is related to conduct and business regulation. And We have objectives, we have types of regulation, and also we have a structure of supervision. There are various combinations in the financial regulation structure, but these are the most important. For example, supervision of the stock markets. That, depending on the country, is the institution that is going to supervise a stock exchange. For example, let me show this link, because in this link we can find different stock exchange in different parts of the world, and who is the institution that regulates the stock exchange, depending on the country. For example, here we have Australia. What is the name of the stock exchange in Australia, and who is the regulatory authority? For example, let's see Brazil. Brazil is Brazilian Stock Exchange, and who is the regulator? Brazilian Securities and Exchange Commission. Or for example, Egypt. Egypt is stock exchange, and who is the authority that regulates this stock exchange? Egyptian Regulatory Authority. And we can have here the stock exchange and who is the regulator here in Mexico. Mexican Stock Exchange, and we have two stock exchange, one that is a Mexican Stock Exchange and other that is Institutional Stock Exchange. We have two stock exchange, and both are regulated by the National Commission on Banking Securities. Or Norway, Spain, Sri Lanka. So we have here we have United Kingdom, United States. So we have almost all the countries, and who is the regulator of the stock exchange of each country. So basically this is the supervision of stock exchanges. In the case of supervision on listed companies, remember that listed companies are the companies that offer debt or debt securities or equity security to the investors. So for that reason, these companies are called listed companies. So these companies are regulated too. Why? Because these companies needs to give to the investor information to create that the investor can believe in the company, to be more transparent. And for that reason, these listed companies that emit debt securities and equity securities are regulated too, because maybe they need to comply, not only give, for example, provide a financial statement in a public web page. They need to comply maybe another requirements, and for that reason, the countries have different organizations that regulate listed companies. For example, in the USA, Securities and Exchange Commission. In UK, FCA, Financial Conduct Authority, or probably in China Securities Regulatory Commission. So normally the same organization, the same institution that regulates supervision stock exchanges, the same regulates listed companies. It's common, but maybe we can have an exemption in some country, but basically the same organization that regulates listed companies is the same that regulates stock exchanges. And also, as a third part of the structure of the regulation, we have supervision of banks and financial services providers. So here we can have banks, or for example, credit unions or cooperatives, all the banks and services providers. So this is important because if we have a strong supervision of banks, we can prevent bad practices or bad operation in banks, and we are going to protect the interests of most of the people in the world. So for that, for this supervision, we have the BIS. This is the link to this organization that regulates the banks and all financial services providers. And to unify the criteria, because in all the countries we have banks and we have financial services providers, this organization created a Basel Committee on Banking Supervision. So all the supervision related to the banking sector or providers of these kind of services are regulated by with basic principles for effective banking supervision. Are regulated by these principles, and these principles were created by a committee. That this committee is called Basel Committee on Banking Supervision. And these principles were created by the G10 because they wanted to unify the practices in banking supervision. So the most important countries created these basic principles, and the thing that they did is joined all the comments, all the situation, all the solutions to have these principles. So they create the principles, and then all the members of the Basel Committee, we decide to not to implement, because at the end it's a principle. They decide to take this principle as a guide to create regulation in every country. So in the regulation, in banking regulation in each country, we are not going to find the principle. We are going to find obviously a regulation established, but this regulation in most of the cases are based on the principles created by the Basel Committee on Banking Supervision. And this is a table that illustrates the division of the most important areas in these principles. For example, supervisory powers, responsibilities, and functions. We can find these areas or these topics in principles 1 to 13. Prudential regulation and requirements. Remember, prudential regulation is a regulation that is concerned about the protection of the interests of the investors and savers, and is worried about, and prudential regulation supervise the operation of banks or financial institutions, because this prudential regulation needs to see that these institutions are following the law. So in principle 14 to 25, we can find this topic, prudential regulation and requirements. And in the third part, is called third-party cooperation, that we can find, for example, how other countries and other jurisdictions and other groups of interest could help to improve financial regulation, principles. And even here in third-party cooperation is important because in this principle in 27, I guess, this principle talks about external auditors and how external auditors could help to improve financial regulation or banking regulation. So this section talks about all the third parties, how other groups and how other external groups could help to improve financial regulation. So again, these principles are only a guide that a country decide if adopt or not, but this is an international guide that most of the countries use to adapt their banking regulation and to be more international. I mean, to be able to compare activities. So for that reason, this is one of the reasons why these principles are important. Now we are going to see how to evaluate a range of risk mitigation methods used in investment. So risk management, as we see in analysis, investment analysis and market analysis, is a process that involves and analyzes the amount of risk involved in an investment. So risk management basically analyze the risk, analyze the uncertainty or the certainty. And I add here a definition of risk. So you can check then this definition. And what are the methods that are used to decrease or to mitigate the risk? We have plenty of methods, but we are going to mention only three, the most important. But we have a lot as the investment theories. For example, a standard deviation. A standard deviation is a measure of dispersion. And this measure is important to see the historical volatility in an investment. For example, a stock has a high standard deviation. So if we have a high standard deviation, it means that we have a very huge volatility. So if we see a standard deviation small, it means that the portfolio or the investment doesn't have a huge volatility. So in a standard deviation are two concepts that are related, that is the amount of a standard deviation and the volatility. If the standard deviation increase, the volatility increase, and opposite. This is the formula to determine a standard deviation. Then we have beta. Beta measure the amount of systematic risk. So if the standard deviation measure the volatility, beta measure systemic risk. For example, in the markets, beta is 1. All the time, beta is 1. So if we have if we want to invest in a company, we need to observe the behavior of the company. If the beta of the company is very close to 1, this means that the risk of this security is not high. So if we are more close to 1, it means that we can predict the behavior of the company in which we are going to invest. So it's better that the beta of the company in which we are planning to invest needs to be very close to 1, because it is a sign that the behavior is according to the market and our predictions will be more precise. Example, suppose that the security beta is 1.5. So in theory, the security is 50% more volatile than the market. So for that reason, I told you, it's better that if we are going to invest in a security, we need to know what is the beta of this security. If the beta of this security is close to 1, it means that it would be less volatile. So it's more convenient that the beta of security, it needs to be very close to 1, maybe 0.90 or 1.20. But if we have, imagine, if the beta of one security is 2, and if the beta in the market is always 1, we have a difference of 1 point. So it means that it's very, very volatile, and if this security has a movement, maybe we can earn the double, but at least, but also we can lose the double. This is the formula to beta, and beta is used in a capital asset pricing model. We are not going to see this model, but beta is used in capital asset pricing model. And then we have value and risk. That bar measures the maximum potential loss in a degree of confidence of a specified period. Imagine, example, that we have a portfolio that has 1 year, 10% of bar of 5 million. So how we can read this scenario if we were using value at risk? Then we can read that therefore the portfolio has 10% chance of losing more than 5 million over 1 year period. So what is basically is value at risk measure the potential loss with a certain degree of confidence. What is the amount of money that we are going to lose? It's like, see the picture on the other side. How much we are going to lose if we have a confidence of I don't know, maybe 10%. And this is a formula of bar. And then we have practical risk mitigation methods. First is handle asset allocation properly. Allocation means that analyze a profile of the investor, such as age, risk tolerance, savings, and financial goals. Diversification, don't put all our money in only one case. Put the money in different cases. So this basically is this diversification. Dollar cost averaging, that is better. Said okay, it's better maybe to invest if we know that the investor is very like they want to be very risk investor, very aggressive. Is maybe may say, okay, give me an amount of money, and this amount of money I'm going to invest in different securities, instead of say, okay, I want three types of securities, and I have debt securities and equity, and I have cash and cash equivalent investments. So instead of invest in different securities individually, is this method or this strategy, dollar cost averaging, is more that give me an amount of money that you want to invest, and the manager needs to look for cover this amount instead of with different kind of securities. No, instead of saying, okay, I want invest in different kind of securities without a control, without have a budget of investing. And now let's go to the topic number 6. Is very short topic because we are going to discuss the client portfolios and in accordance with the customer profiles and recommendation to know how to save and how to invest. Risk tolerance is a concept that is involved in how we can create a portfolio, because risk tolerance is the degree of variability that an investor could take or could face. So this is tolerance. How many risk, how much risk the investor can take. And normally risk tolerance is associated with age, but not only is but it's not only the factor that we need to consider to evaluate risk tolerance. It is one of the factors, but is not the only one. But average is very important. Age is very important. And according to the risk tolerance, we have different types of profiles in the investors. Maybe if we consider, for example, the age of an investor, let's say that we are considering only the age of the investor. Maybe this investor is if the investor is very old, maybe his profile will be risk adverse, that because this is very old, so maybe this person could die in any moment. So the profile could be risk adverse or conservative. Maybe conservative for a person that doesn't have a lot of knowledge of investment. Or maybe it's a person that is very young, is very active. This person has a medium to high knowledge of investment. So maybe the profile for this person could be aggressive or very aggressive. So according to the age, the knowledge of the securities, the market, maybe according to the amount that they want to invest, the purpose, the profile is given. In this link, you can check one example of one checklist, a questionnaire which some of the investment bank use to determine the profile of the investor. If you want to check then, this is a link in which you can check this questionnaire. And other important picture that I wanted to show you is this picture, because this is an overview. This is not a rule. This is an overview to understand how the investor, in which types of securities or in portfolios the investor could invest, depending on the risk, or basically in their profile. If they are, for example, moderate risk, if they are aggressive or conservative, for example, for a very aggressive commodities. Remember that commodities are financial instruments that that are based on raw products like coffee or sugar or chocolate. So a very aggressive investor could invest in commodities, or for example, not very aggressive cash, or on money, not very aggressive money market funds. So it is very helpful table in which you can understand, depending on the risk, in which kind of securities or assets or stocks or financial instruments you can invest, or the investor can invest. And recommendation of appropriate types of saving and investments. First is handled with the asset allocation. It means that asset allocation is what is the objective that the investor needs to cover, and maybe how I'm going, depending on this goal, on this purpose, the manager could create a portfolio, maybe a combination between debt or equity, or maybe common equity and preferred equity. I don't know. This is an asset allocation in which securities I'm going to invest. Diversify, a concept very common. We are not going to, we need to avoid invest our money in only one security. Monitor the investment regularity in order to see how is the behavior of the securities, and depending on this, again, handle asset allocation. If we can see that maybe the trends are changing, maybe we need to allocate in different type of securities. And last, maintain adequate liquidity, because some investors, or we need to consider that we need to have liquidity. This is invest in securities or investing in financial instruments in which we can recover easily. No, maybe in a security that we will receive the payment or the yields in a long term. No, we need to consider invest in securities that in which we can have liquidity. That this last point is very related to diversify. So if we diversify in long term, in short term, depending on the risk, depending on the purpose, and this is this concept, this last point is very associated with diversify, because we need to consider that in some times for emergency, we need to have cash in order to cover any emergency that we can have or that the investor could have. So basically, these are the 4 recommendations for appropriate types of saving and investments. So do you have any questions?